Good Monday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer and David Faber. It is an historic day in the media business as Discovery and AT&T's Warner Media agree to merge, creating a new Goliath in streaming. We'll talk to Zaslav and Stanky at 10:15 a.m. Eastern Time. In the meantime, futures are a bit soft to start a busy week of retail earnings. We'll get some updates to 13Fs, some housing data. But, David, there's no disagreement on where the focus is today.
Yeah, you know, it's a stunning deal, I have to tell you. And listen, not to go too deeply into it, but it's something that I'd been working on for, knew something was going on some time ago. You guys may remember when Viacom sold stock on the big run-up because of Archegos. Why didn't Discovery, right? When that piqued my interest at the time. And it clearly was because they had MNPI, what we call material non-public information. And what it was they were talking about this. But all along during that process of trying to understand what might be happening here, I got to tell you guys, I never anticipated that it would actually be AT&T deciding to part with all of Warner Media. There had been plenty of expectation that at some point, perhaps very soon, they would choose and try to sell Turner, which comprises CNN, TBS, TNT, and Cartoon Network. But to go all in, Jim, if you're Stanky, and basically reverse much of what your predecessor, Randall Stevenson, did in terms of DirecTV, which, of course, they also have done a transaction for. Remember, they're going to own a good deal of it, but it's being managed by another company, and it's being offloaded, and the debt is going with it, or some of it. And then to do this transaction less than 3 years after completing the deal to acquire Time Warner, fighting through a regulatory disaster for them, and the courts took them 2 years to get it done, only to turn around and say, we're out. Now, 71% of the combined company will be owned by AT&T shareholders. Remember, it's a reverse Morris trust. It's tax-free to AT&T shareholders. It transforms AT&T, of course, back to a pure wireless company. And it does make Warner Discovery a giant in the media business around the world.
Well, does that give the AT&T shareholder the equivalent of a good dividend? Because if you're targeting the dividend payout ratio of 40 or 43%, of anticipated cash flow of $20 billion, well, that's a dividend cut from $15 billion to $8 billion.
It's going to be a very different capitalized company. Now, remember, they're offloading $43 billion in debt. That's kind of the net debt reduction.
And they need to be able to pay for towers.
Right. So the new Warner Discovery, obviously, is much more indebted. It levers itself up over time. And they say very quickly, by the way, Zaslav says, as soon as 2023, they'll be down to 3.5 times net debt to EBITDA.
That's great, but, if you cut the dividend, thank you to Craig Moffat for some of this. 4 weeks ago, I heard that it was a great dividend play and that the assets work well together. Here, do you ever take the crosstown bus?
Yeah, I have.
Well, who's underneath it right now?
It's very slow. I don't know.
I think Stevenson is. I mean, you could say Greyhound, but no one takes that anymore.
No.
He threw him under the bus.
Yeah.
And I got to tell you, I feel personally, having, thank heavens, not recommended this stock other than to say, well, look, I think it could be good.
But Jim,
the dividend cut.
There may be a frustration with the fact that AT&T stock price has done very little for a very long period of time.
So cut the dividend?
And that wireless business is doing quite well.
Yes, they have to.
Right. So you get now back to being a pure wireless company. You give your shareholders an opportunity to participate in better growth with a combined company being run by David Zaslav, who you believe is going to be able to execute on your direct-to-consumer plan in a perhaps better way than you were going to be able to, or certainly in a way that is going to actually reward that growth, as opposed to with AT&T, where maybe you just weren't getting what you deserved in the stock market. That at least has to be part of the thinking of John Stanky.
But didn't Stanky come on air and say the way to make this a good deal is to get the stock price up, okay?
Yes.
That's how the yield would grow.
Well, no, he said the way to get the dividend yield down is to get the stock price up because people question the dividend, right?
But that is not necessarily what they're doing.
No, they're reducing their debt substantially.
Right.
They are creating a pure play wireless company to be able to compete more effectively with T-Mobile.
Well, they have to because no one thought that the auctions were going to cost this much.
They spent $30 billion in that auction or more, right?
Yeah. And who is the great American behind all this?
Jeff Bewkes.
Exactly.
Yes.
He sold at the top.
$107 billion
Stevenson
total
paid
value,
at the top,
including debt when they sold. When they closed the deal, and obviously it was announced back in 2016, but it didn't close till 18.
Other than the mayor of Easttown, what are they really getting?
That's a dark show, man.
Oh, come on. She's fabulous. All right. So, David, I just want to understand this. And Carl, we watched Stanky. And I think the takeaway was you're going to have good growth, good entertainment assets, which make it so that AT&T is distinguished as a great entertainment company, and that huge dividend. Well, but they're undoing the entertainment. The dividend will be cut in because it's anticipated cash flow. And where was the synergy all along?
Shepard Smith here. Thanks for watching CNBC on YouTube.